The first sign never appears on a chart. It doesn't flash across Bloomberg terminals or ripple through financial headlines. It happens in silence, inside a mechanism most investors never bother to understand, a cold, metallic valve buried deep within the Federal Reserve's balance sheet machinery. It's a place so technical, so deceptively boring, that even seasoned analysts treat it like background noise. But that is where the real story begins, in the quiet places where power hides, and where money doesn't just move, it's pulled. At the center of that pull is something the Fed built not as a primary policy tool, not as a message to markets, but as a pressure drain the system should never have needed: the overnight reverse repo facility, or ON RRP. If you could walk into the Fed's internal plumbing and turn the lights low, you wouldn't see an interest rate lever or a liquidity dial. You'd see a silent chamber, a vault designed to absorb excess cash when the system is drowning in liquidity. Most people imagine financial crises come from shortages. Not enough reserves, too little collateral, too much leverage. But the hidden truth, the forbidden truth, is that Washington once feared the exact opposite. There was a moment when the financial system was so swollen with cash, so flooded with reserve balances created by quantitative easing, that it needed a black hole. It needed a device capable of pulling hundreds of billions, even trillions, out of money markets overnight without triggering panic. That is why the ON RRP exists. And that's why understanding it feels like reading a file you were never supposed to open. Let's break down what it actually does in the simplest terms. Think of the entire financial system as a network of pipes filled with water, which represents cash. The Fed's job is to keep the pressure just right. After 2008, and especially during the pandemic, the Fed opened the floodgates with quantitative easing, buying trillions in bonds and pumping cash directly into the banking system. But this created a new problem. There was too much cash sloshing around, especially in non-bank institutions like money market funds. These funds had nowhere to put their cash to earn a safe, positive return. When there's too much cash chasing too few safe assets, short-term interest rates can fall to zero or even go negative. This would break the Fed's control over its target interest rate and signal that the entire system is malfunctioning. To prevent this, the Fed opened the ON RRP drain. Every night, money market funds can park their excess cash with the Fed and receive a small amount of interest in return, collateralized by Treasury bonds. The facility isn't meant to be a permanent home for money. It's a temporary parking spot, a safety valve. When usage is high, it means the private market can't absorb all the liquidity. When usage is low, it means that cash is finding a home elsewhere in more productive assets. And once you start paying attention, the pattern becomes impossible to ignore. Each time the Fed loses control of its own plumbing, each time liquidity starts slipping out of its intended channels, each time market stability rests on a razor's edge, the ON RRP begins to hum quietly in the background. It absorbs the flows that reveal far more than the Fed is willing to say in public. For 2 years, we watched this facility swell to over $2 trillion. It was a silent testament to the unprecedented scale of monetary stimulus. It was the financial system's quiet confession that it was overwhelmed. But now, that drain is emptying at a historic pace. From a peak of over $2.5 trillion, the balance has plummeted, heading towards zero. And this is the part of the story that matters right now. Why is the cash leaving? There are 2 main reasons, and they both tell a critical story about where we are heading. First, quantitative tightening, or QT. The Fed is no longer buying bonds. It's letting them mature and roll off its balance sheet without reinvesting the proceeds. This pulls liquidity out of the system. Think of it as the Fed slowly closing the main water valve. Second, and more importantly, the U.S. Treasury has been issuing a massive amount of new debt T-bills to fund government spending. These T-bills offer a higher interest rate than the ON RRP, so Money market funds are taking their cash out of the Fed's facility and buying these new, attractive government bonds instead. This is exactly what the Fed wants to see. The cash is moving from a sterile parking lot back into the financial system, financing the government's operations. On the surface, this looks like a perfectly engineered soft landing. The system is rebalancing itself. Excess liquidity is being soaked up, and the plumbing is returning to normal. But here's the crucial question. What happens when the drain is empty? What happens when that $2 trillion cushion is gone? When the ON RRP hits zero, the dynamic changes completely. With that buffer gone, the continued effects of quantitative tightening and Treasury issuance will start pulling reserves directly from the banking system itself. This is where the risk lies. Bank reserves are the lifeblood of the financial system. They are the cash banks used to settle payments, meet regulatory requirements, and lend to each other. If bank reserves get too low, the system seizes up. This isn't a theoretical risk. We saw it happen in September 2019 when a sudden shortage of reserves caused overnight lending rates to spike dramatically, forcing the Fed to intervene with emergency liquidity injections. The system, for a moment, broke. The concern now is that we could be heading toward a similar event, but on a much larger scale. The rapid draining of the ON RRP is the countdown clock. It tells us how much time we have left before QT starts to really bite into the core of the banking system. It is a race between the Fed's desire to normalize its balance sheet and the system's need for a minimum level of liquidity to function smoothly. No one knows exactly what that minimum level is, but we will find out when we cross it. And so, we're not looking at headlines. We aren't listening to the carefully crafted language of FOMC speeches. We're stepping into the basement of the dollar system, into the shadows where policy theory ends and the real machinery begins. Because the ON RRP is not just a facility. It is a confession evidence of how fragile the system became, how badly the Fed needed an emergency escape route, and how quietly that escape route has become one of the most important signals in global finance. The emptying of this facility is the canary in the coal mine. It's the silent warning that the era of abundant, endless liquidity is over. The forces that define the last decade are reversing. We are moving from a world of excess cash to a world of cash scarcity. This shift will have profound implications for asset prices, for credit markets, and for overall financial stability. So, as you watch the markets in the coming months, don't just look at stock prices or listen to analyst predictions. Keep one eye on that deceptively boring chart showing the balance of the overnight reverse repo facility. Because when that drain valve ignored by most, misunderstood by many, and dismissed by nearly everyone finally runs dry, it means the real test is about to begin. It's one of the earliest warnings we ever get. Before shortages become headlines. Before market fractures become crises. The truth is simple. When the ON RRP moves, the system is already whispering. And we just followed that whisper all the way down. When the world's financial system shattered in 2008, what truly terrified the Federal Reserve wasn't the collapsing banks or the panicked headlines. Those were the loud, visible wounds. The real fear came from something silent, a discovery made in the quiet chaos. The Fed no longer understood its own dollar system. In the weeks after Lehman Brothers failed, the central bank unleashed a torrent of emergency cash to stop the bleeding. But this money, trillions of dollars of it, didn't behave as expected. It didn't flow through the economy's veins like it used to. Instead, it pooled, it stagnated, it broke the very channels the Fed used to guide the economy. The old steering wheel was no longer connected to the wheels. The machine had changed. Before 2008, the system ran on what's called scarce reserves. Banks held just enough cash to settle their daily business. The Fed could make small adjustments, adding or removing a few billion, to steer interest rates with surgical precision. It was delicate, responsive, and predictable. But then came quantitative easing, or QE. Suddenly, reserves weren't scarce. They were everywhere. Banks were drowning in cash they didn't need or want. The old system, built on scarcity, collapsed under the weight of this new abundance. The Fed realized it had a massive problem. Too many reserves to control with its old tools, but too much fragmentation to control with its new ones. To regain control, the Fed introduced a new tool, interest on excess reserves, or IOER. The logic was simple. The Fed would pay banks a risk-free interest rate on the cash they held. In theory, no bank would ever lend money to anyone else for less than what they could get, risk-free, from the Fed. IOER was meant to be a solid floor under interest rates, an anchor in the storm. But it didn't work. The post-crisis financial system wasn't a single unified ocean. It was a complex maze of pipes, and not all of them were connected. Only banks could earn this new interest rate from the Fed. Major players like money market funds were locked out. So, these institutions kept lending their cash at lower rates, pulling the entire market down with them. The Fed's new floor was a floor in only one room of a house whose foundation had already cracked. This was the moment the Fed quietly admitted to itself a truth it couldn't say out loud. It needed a second tool. It needed another valve, one that could reach the parts of the system that IOER couldn't. It needed a way to set a floor for everyone, not just the banks. And it had to do it without signaling panic, without admitting that its control had slipped. This was the birth of the idea that would become the overnight reverse repo facility, or the ON RRP, a silent drain valve designed to pull cash out of the system when needed. In 2008, this was just a concept whispered in closed-door meetings, a tool for a world the Fed hoped it would never have to live in. As QE continued for years, the system only grew more distorted. Reserves ballooned to levels never seen before. Money market funds were swimming in cash they couldn't invest safely. The plumbing of the dollar system, once driven by the natural rhythm of borrowing and lending, was now a series of disconnected pools. The Fed was pumping in oceans of liquidity, yet parts of the market were drying up. By 2013, the Fed knew it couldn't rely on its broken tools any longer. It decided to test its secret weapon. Quietly, almost as an experiment, it launched the first phase of the ON RRP facility. It wasn't advertised as a major policy shift. The official line was operational testing, a phrase perfectly designed to bore everyone and attract no attention. The Fed opened a window for money funds and other non-banks, offering them a safe place to park their cash overnight for a small return. The idea was to create a true floor, one accessible to all. But the results of this test were stunning. The amount of cash that flooded into the facility was far greater than anyone expected. It was the first public sign of how broken the system really was, how desperate non-banks were for a safe haven for their cash. The experiment was supposed to be temporary, but the market acted as if it had been waiting for this lifesaver all along. The story the public believed that the Fed was still in complete control with its traditional tools was beginning to unravel, though almost no one noticed. The truth was, a new system had been born. A dual plumbing architecture with two floors, IOER for banks and ON RRP for everyone else. When the Fed finally decided to raise interest rates in 2015 for the first time since the crisis, something incredible happened behind the scenes. It was an IOER, the tool everyone talked about, that was doing the heavy lifting. It was the ON RRP, the quiet experiment that was secretly anchoring the entire financial system. It absorbed hundreds of billions of dollars, stabilizing markets whenever pressure built up. The system had silently rewired itself around this new, unacknowledged pillar. Then came 2020. The pandemic unleashed a wave of government intervention that dwarfed even 2008. QE returned with a vengeance. Money flooded into the system on an unprecedented scale. And the conditions that the ON RRP was originally designed for too much cash, not enough safe places to put it, returned with an intensity no one could have imagined. By 2021, the inevitable occurred. The ON RRP facility, once a quiet side project, exploded. What started with a few $billion swelled to over $1 trillion, then $1.6 trillion, then over $2 trillion. At its peak, $2.5 trillion were draining into this facility every single day. The system was screaming a message that the Fed refused to say publicly. There was so much cash trapped in the wrong places that only this emergency drain could stop interest rates from collapsing below zero. The ON RRP had gone from a temporary tool to an indispensable pillar of the financial system. And this created the second, more dangerous illusion. The public was told this was just a harmless side effect of a strong economy and necessary stimulus. But the real story was much darker. The explosion in the ON RRP wasn't a sign of health. It was a signal of a profound sickness deep inside the dollar's plumbing. It showed that money wasn't flowing, it was pooling. It wasn't circulating, it was stagnating. The entire system had become addicted to a drain valve that was never meant to be permanent. The leak was hiding in plain sight. When the ON RRP swelled to trillions, it wasn't just absorbing cash. It was revealing the deep fractures that had formed beneath the surface of our financial world. The Fed had built a new architecture after 2008, but the pressure inside the pipes had only grown. And the moment that drain starts to empty, the world is going to find out just how fragile that new system really is. For years, we've heard the same story about the global financial system. There's just too much money. Analysts, policymakers, even the Federal Reserve itself pointed to one thing as proof: the overnight reverse repo facility, or ON RRP. It swelled to over $2 trillion, and the official narrative was simple. This was just a harmless overflow tank, a place for excess cash to sit when there was nowhere else for it to go. A temporary fix. But what if that wasn't the whole story? What if the ON RRP wasn't just an overflow tank, but a map of the hidden stress points inside the entire dollar system? There is a moment in every complex system when the story we retold and the reality underneath finally collide. For the ON RRP, that moment didn't come with a bang or a major crisis headline. It arrived quietly with a subtle reversal. The day the drain stopped filling and started emptying. This wasn't supposed to happen. Not in a system that was supposedly abundant with reserves. A facility like this doesn't just shrink for no reason. It contracts because the fundamental incentives are changing. It shrinks because money that once had no home is suddenly being pulled somewhere else, somewhere we're not supposed to be looking. That was the real twist. The ON RRP wasn't just absorbing excess cash. It was measuring the tension. When its balance rose, it signaled a massive oversupply of money with nowhere to go. But when it started to fall, it signaled something far more concerning: scarcity. And in the modern financial world, where we've been told reserves are everywhere, scarcity is a word you're not supposed to hear. But it was happening. Quietly at first, then unmistakably. The same money market funds that had been pouring trillions into the facility for safety suddenly started pulling their cash out. Why? You didn't see a single headline explaining it. No press conference addressed the shift. But for anyone who understood the deep plumbing of the financial system, the message was crystal clear. Something under the surface was tightening. The public was still being fed the old line. Banks are swimming in cash. Quantitative tightening is just a smooth, mechanical process. But the ON RRP data was telling a completely different story when the Fed wasn't broadcasting. Money funds were no longer desperate for the Fed's facility because other options were becoming more attractive. Treasury bills, for instance, started offering better returns. Suddenly, there was competition for that cash. At the same time, banks, which we were told were saturated with deposits, started needing those reserves again. The entire dynamic was shifting. The very floor that had been holding up the system was now acting like a mirror, reflecting the growing internal stress. So, the big question wasn't just that the ON RRP's balance was falling. The real question was, where was all that money going? It was migrating back toward the core of the banking system. It was flowing into Treasury bills. This was a rebalancing, but not one happening by calm, careful design. It was a rebalancing under pressure. The very pipes that had once seemed to be drowning in liquidity were now showing the first signs of being starved. Of course, the official statement from the Fed was predictable. The ON RRP was functioning as intended. That calm, bureaucratic phrase is a classic for a reason. It's designed to soothe markets and project control. But it masked a much more unsettling truth. The entire system had become dependent on this one facility, this one drain, valve to keep short-term interest rates from breaking through their targets, and now that valve was closing. Think about it like a pressure cooker. When you have a release valve, you can manage the pressure inside. But what happens when that release valve starts to close? The pressure has to go somewhere. In the financial system, that means one of three things can happen. Either interest rates start to rise uncontrollably, or reserves start shifting violently between institutions, or the funding markets, the overnight lending that keeps everything running, begin to fracture. None of those outcomes ever appear in an official press release. But they all show up in the data, in the plumbing, if you know where to look. This was the moment that insiders understood what the public still couldn't see. The ON RRP was no longer just a facility. It had become a leading indicator of structural stress. It was a barometer of just how tightly reserves were being pulled back into the core banking system. And as that balance dropped day after day, the implication became sharper and sharper. The massive cushion that had once absorbed trillions of dollars was vanishing. Whatever pressure came next would have nowhere to go. The twist wasn't some dramatic collapse you see in a movie. It was something quieter, and in many ways, far more ominous. The silent disappearance of a safety net the entire world had come to rely on. The ON RRP had been a silent witness to years of imbalance, a stabilizer for a world of distorted incentives created by massive money printing. Its decline signals the end of that era. The very mechanism that once masked the system's fragility is now revealing it. And in that quiet reversal, one truth has become undeniable. We are entering a new phase where every little shift matters, where every basis point change in an interest rate carries a world of meaning, and where every surge or drain of reserves hints at deeper vulnerabilities we haven't yet faced. For over a decade, the world grew accustomed to thinking of liquidity as infinite, frictionless, and endlessly available. But the reversal in the ON RRP whispered a warning that no headline ever captured. Liquidity is becoming directional again. It's no longer just sitting there. It's moving. It's choosing sides. And it's choosing not to stay where it once was. A way for the Fed to control interest rates. A place to drain extra cash. But that's like calling the Grand Canyon a big ditch. To truly understand what the ON RRP is, you have to peel back the polite descriptions and look at the raw mechanics, the hidden incentives, and the structural pressures that forced it into existence. Because this isn't just about parking cash overnight. This is the story of a new monetary regime, one born from crisis and now running on trillions of dollars a day. Let's start with a simple but game-changing fact. For most of history, only banks could deal directly with the Federal Reserve. Only banks could park their cash there and earn a risk-free return, what's known as interest on reserves. This created an exclusive club. But after the 2008 financial crisis, this exclusive system started to break. The Fed pumped trillions of dollars into the economy, but that money overwhelmingly sat inside the big banks. Meanwhile, a whole other universe of financial players like money market funds, which hold trillions of our savings, were floating in a sea of cash with nowhere safe to put it. Think about it. In 2010, these funds held over $2.7 trillion. They needed a safe, liquid place to invest, but they couldn't just go to the Fed. At the same time, the usual safe haven, Treasury bills, was in short supply. Demand was huge, especially as new regulations forced funds to be more cautious. This imbalance created a major problem. Short-term interest rates started to disconnect from the Fed's main policy rate. The system had fractured into a two-tiered world, the banks with direct Fed access and everyone else. The Fed's primary tool for controlling interest rates just wasn't working properly anymore. So, in 2013, the Fed unveiled its solution, the overnight reverse repo facility. The plan was to weld the two tiers of the financial system back together. Mechanically, it's pretty simple. The Fed sells a security to an eligible institution, like a money market fund, and promises to buy it back the next day at a slightly higher price. That price difference is the interest. In effect, the Fed is borrowing cash overnight from non-banks. But this simple transaction has a massive systemic impact. It creates a guaranteed floor for short-term interest rates. Why? Because no rational institution is going to lend money to a risky private company for less than what they can get from the Federal Reserve itself, risk-free. If the ON RRP offers a rate of 5%, nobody will lend for 4%. It becomes the absolute bottom, the bedrock of the market. And it worked. When the Fed turned on the facility, the federal funds rate, which had been slipping, snapped back into the Fed's target range. It wasn't just a supplementary tool. It was the anchor. For a few years, the ON RRP operated in the background, doing its job. Usage would spike at the end of a month or quarter, maybe hitting a couple $100 billion, and then recede. It was a useful feature, a backstop. But then, 2020 happened. The pandemic response unleashed a financial tsunami unlike anything in modern history. The Fed's balance sheet exploded by over $4.5 trillion. Fiscal stimulus sent trillions more flooding into people's bank accounts. Suddenly, banks were drowning in deposits. This might sound like a good problem to have, but post-crisis regulations, like the supplementary leverage ratio, put a limit on how big a bank's balance sheet can get relative to its capital. Reserves, even though they are the safest asset possible, count towards this limit. Banks were hitting their regulatory ceilings and had to start turning away cash. They couldn't absorb any more. At the exact same time, another problem was brewing. The U.S. Treasury, which had built up a massive cash pile, started spending it down. This meant it didn't need to issue as many new Treasury bills. In fact, the supply of T-bills fell by over $700 billion in 2021. So let's recap the situation. Money market funds are legally required to hold safe, liquid assets. Banks won't take their cash. And the supply of Treasury bills is shrinking. Where do trillions of dollars go? There was only one place left. The floodgates opened, and a tidal wave of cash poured into the overnight reverse repo facility. From basically zero in early 2021, the facility's balance surged past $1 trillion by summer. It hit $1.6 trillion by the fall, and by the end of the year, it was a staggering $1.9 trillion. A year later, it peaked at over $2.5 trillion. This wasn't a temporary spike. This was the largest liquidity absorption event in the history of modern finance. And it revealed a critical, unspoken truth about our financial system. It was so imbalanced, so flooded with cash that had nowhere else to go, that trillions of dollars were trapped. They were stuck in institutions that couldn't access the traditional banking system or find enough safe assets to buy. The only thing preventing overnight interest rates from collapsing into negative territory, which would have created chaos, was the ON RRP. It wasn't just a floor anymore. It was the entire foundation. The Fed had accidentally built the one escape valve that kept the entire short-term funding market from freezing solid. Money market funds, these massive pools of cash, have a simple job: find a safe place to park money overnight. But they have strict rules. They need high-quality, super liquid assets. They can't just open a checking account at the Fed, so they're constantly searching for safe collateral. Now, what happens when the supply of that safe collateral, like Treasury bills, shrinks? Or when the interest rate on those bills drops super low? The money has to go somewhere. This is where the ON RRP comes in. Think of it as the Fed offering a safe, overnight parking spot for this cash. Let's look at 2021. The interest rate on a one-month Treasury bill fell to almost nothing, just 0.5 basis points. Meanwhile, the Fed's ON RRP facility was paying 5 basis points. For a money market fund manager, the choice was a no-brainer. In just a few months, over $1 trillion flooded into the facility. The Fed accidentally became the single largest counterparty to money funds in history. When the ON RRP balance is high, it means the financial system is overflowing with cash that has nowhere else to go. But what's even more important is what happens when that money starts flowing out. A decline in the ON RRP balance is a mirror. It reflects a tightening in the system. It tells us that either Treasury bill yields are rising, making them more attractive again, or that banks are getting thirsty for cash and are pulling liquidity back. It can also mean that quantitative tightening, or QT, is draining reserves from the system, forcing cash back into the banking core. And we've seen this happen in real time. In early 2023, the ON RRP balance started to fall from its peak of nearly $2.5 trillion. By late 2023, it was under $1 trillion. By early 2024, it was hovering around $400 to $600 billion. This wasn't a sign of normalization. It was a sign that the system's spare capacity, its safety buffer, was shrinking fast. Why? Two big reasons. First, the Treasury started issuing a massive amount of new bills after the debt ceiling was suspended. Suddenly, there was over $1 trillion of new, attractive collateral for money funds to buy. Second, the Fed's quantitative tightening continued to drain reserves from the banking system. Banks, feeling the pinch, started needing more funding, and money funds were there to provide it. This leads us to a crucial insight. Money in the ON RRP isn't just cash on the sidelines. It's money with nowhere else to go. When the balance is high, the system is waterlogged with liquidity. When it falls, the system is tightening. And when it gets close to zero, the system is nearing a fragile state where any new stress falls directly onto the banking system's reserves. And that's where things get dangerous. The Fed's entire system for controlling interest rates relies on having abundant reserves. But QT is actively draining those reserves. We've seen this movie before. Back in September 2019, repo rates suddenly spiked to 10%. At the time, there was still $1.4 trillion in reserves, a level that seemed high. But the market showed us that the effective minimum level of reserves was much, much higher than anyone at the Fed thought. So, here's the scary part. If the ON RRP facility drains to empty while the Fed continues QT, the entire burden of managing liquidity falls back onto a dwindling pile of reserves. And those reserves might not be enough to prevent another spike in rates or a major funding crisis. The Fed built the ON RRP to solve a problem of too much money. But as the situation flips from abundance to scarcity, the decline of the ON RRP exposes the system's true vulnerability. The drain valve is closing right when the pressure is building up. Surplus liquidity is an annoyance, but scarcity is a genuine danger. This isn't just a domestic issue either. This dynamic shapes global markets. When the ON RRP is full and bill yields are low, global dollar funding conditions get tight. When the ON RRP drains and bill yields rise, it strengthens the dollar's gravitational pull on global liquidity. That's why we often see a dollar funding squeeze happen at the same time the ON RRP balance is falling. In mid-2023, as the ON RRP dropped by nearly $1 trillion, the cost for foreign institutions to get their hands on dollars went up. The hidden plumbing of the dollar system reacts instantly to these shifts. But let's bring it back home. When cash leaves the ON RRP, it has to go somewhere, either into Treasury bills or back into bank deposits. But banks have limits on how much leverage they can take on. If they're already constrained, they might not want those new deposits. This can create a bizarre feedback loop. Cash drains from the ON RRP, banks absorb it, their leverage pressure rises, so they pull back on other activities, which causes funding rates to rise, pushing money funds right back to the Fed's ON RRP. The system just oscillates around these constraints, with the ON RRP acting as the pressure gauge. And here we arrive at the final truth. The ON RRP isn't temporary or optional. It's a foundational piece of the modern financial system. The Fed's main policy rate, the interest on excess reserves or IOER, is only accessible to banks. But most of the money market doesn't consist of banks. Without the ON RRP providing a floor for everyone else, short-term rates would be chaotic. The entire system is built on this dual-floor architecture. That's why every single move in the ON RRP balance is a critical signal. When the Treasury issues more bills, it falls. When QT tightens reserves, it falls. When banks get stressed, it rises. Every shift is a message about stress, relief, or displacement in the financial system. It exposes a simple but uncomfortable reality. Money doesn't just move freely. It's channeled by regulation, by risk, by balance sheet capacity, and by who has access to the Fed. The ON RRP is the one place where all these forces meet and become visible. As its balance shrinks toward zero, the real question isn't whether the system can function without it. The question is how long the system can withstand the building pressure once this crucial safety valve is empty. When you look at the Fed's ON RRP facility today, it's tempting to feel a sense of relief. It's smaller, quieter, and seems like a problem that's already been solved. It's easy to dismiss the trillions of dollars it once held as just a strange side effect of the pandemic, a temporary glitch in the financial system that has now corrected itself. But that's a dangerous oversimplification. Financial systems have a long memory, especially when it comes to their weak spots. What the ON RRP facility showed us over the past few years wasn't just a fleeting imbalance. It revealed a fundamental truth about our modern financial world. That truth is this: the system needs a safety valve. It needs a place to park massive amounts of excess cash to prevent things from breaking, and it also needs a buffer to draw from when cash becomes scarce. The ON RRP facility was both. It acted as a giant shock absorber. But now, that shock absorber is wearing thin. The balance is draining away, and a critical question hangs in the air. Can the system handle the next period of financial stress without it? Think of it like a machine with a drain valve. When that valve is open and the machine is full, there's plenty of room for error. But as the level drops and the valve gets closer to empty, the entire system becomes more fragile. Every small change has a much bigger impact. Suddenly, every shift in bank reserves matters more. Every Treasury bill auction feels more significant. Every tiny flicker in short-term lending rates becomes a potential warning sign. When the ON RRP held trillions, it masked these signals. It smoothed out the bumps, kept interest rates from going haywire, and created a powerful illusion of infinite, easily accessible liquidity. But illusions don't last forever. As the money flows out of the facility, we're seeing the financial system in its true, Natural state a world where liquidity isn't actually abundant. It's just borrowed, rerouted, and balanced by tools that were never meant to be permanent fixtures. What makes this moment so fragile isn't that the ON RRP is shrinking. That was always part of the plan. The real problem is that the financial system has forgotten how to function without it. It's become dependent on this safety net. The Federal Reserve's current policy framework is built on the idea of ample reserves, but quantitative tightening is eating away at those reserves every single day. Banks are operating under the assumption that their deposits are stable, but they've seen how quickly trillions can move when money market funds find a better return elsewhere. And markets are counting on a steady supply of Treasury bills for collateral, but government issuance doesn't always line up with the market's funding needs. The ON RRP was the hidden gear that kept all these moving parts from grinding against each other. Its very existence defined the boundaries of financial stress. And now, as it disappears, those boundaries are being erased. The most unsettling part is that this kind of shift doesn't start with a dramatic crisis. It doesn't make headlines right away. It begins quietly, just like it did when the facility started swelling in the first place. You see the early signs in subtle places. The cost of overnight borrowing inches up. Money market funds start favoring Treasury bills over the Fed's facility. Cash reserves start getting concentrated in just a few large banks. You notice a little more volatility in interest rates at the end of each month. None of these are signs of a system failure, not yet, but they are signals. They are reminders that the system is drifting back toward a more dangerous state, a world where every adjustment carries risk, every imbalance spreads faster, and the line between stability and crisis gets thinner with each passing month. This is why it is so crucial to understand this mechanism now before the mainstream news starts talking about it. The ON RRP has always been the ultimate early warning system for stress in the financial plumbing. It's the one place where we can see the unfiltered, unbiased decisions of major financial institutions. When they rush money into the facility, it signals a fear of having too much cash with nowhere safe to put it. When they pull money out, it signals a surge for yield and a potential fear of future scarcity. And when the balance gets close to zero, it reveals the simplest and most important truth. The system's capacity to absorb pressure is fading. The danger right now isn't a loud, obvious explosion. It's more like the air slowly thinning in a sealed room. You don't notice it at first, but the effects are building. A scarcity of reserves doesn't just appear out of nowhere. Cracks in the funding markets rarely begin with a bang. They start with whispers, with tiny distortions in the system that get amplified as they move through the financial pipes, unnoticed until they finally break through to the surface. And the ON RRP, the most sensitive and silent of all these channels, is the first to detect that shift. So, as we watch the ON RRP balance continue to fall, remember what you're really seeing. This was never just some obscure facility. It was a mirror reflecting the hidden pressures that the financial system preferred to ignore. It was a window into the true state of liquidity. For a decade, it was the stabilizer that held things together through extreme policies and unprecedented events. It was the pressure valve for a machine that was no longer responding to its old controls. Its decline is not the end of the story, it is a warning. It's a signal to pay closer attention to the plumbing of the financial system. Follow the flows of money. Listen for the signals hidden beneath the market noise. Because the next time bank reserves get tight, the next time there's a scramble for high-quality collateral, the next time interest rates move in ways that defy the experts' models, there won't be a trillion-dollar buffer waiting in the shadows to cushion the blow. There will only be the system as it truly is, exposed, unfiltered, and forced to face the consequences of a decade spent hiding its problems behind a silent drain.